Okay, folks, welcome back. Before we get into the topic, it's very important that we remind ourselves that this is a commodity market discussion, and it's important that you read the disclaimers here. I'm not a CTA, I'm not a commodity trade advisor, so it's very important that you understand that everything we say here is all specifically talking about paper trading only. Okay, folks, welcome back to lesson 3. This is June 2017 ICT mentorship, commodity trading, lesson number 3, seasonal tendencies, my personal favorites. Okay, we're looking at the first on our list, and we're going to be talking about the agricultural markets first, and then we'll go into the financials. But before I begin, I want to, number one, stress that panaceas don't exist. Be-all, end-alls don't exist in trading, and certainly seasonal tendencies are not one. While my personal belief is that there's validity behind them, because of human error, because of the seasonal tendency not taking effect of the time of a trader sitting down and trying to implement them, just know that you can lose money if you try to place all of your faith on seasonal tendencies. But my personal interpretation of seasonal tendencies are, it's like a roadmap or like a treasure map, if you will. It kind of like gives me the normal expectation of what should normally be seen in price action that time of year. Now, anything can happen, obviously, with agriculturals. There could be a drought. There could be a bumper crop, meaning there's a lot of supply, and a drought would create a short supply, and demand would go up, and obviously the prices would go through the roof. But when we have these seasonal tendencies, again, it's important that we remind ourselves, like I did when I mentioned them earlier in the mentorship, that they're not panaceas. They are not going to be absolute, but they're good roadmaps as to what to expect for each individual, in this case, commodity. So the first in our list here, the seasonal tendency for the soybean market. On the left-hand side of every slide I show you, I'm going to present the seasonal tendency on the left and then a weekly chart over the last 5 years. So that way you can look at price and form for your own opinion whether there's any validity to having these seasonal tendencies in our toolbox at all. I believe by your study and your interest, by seeing whether these things come to fruition or not in the old data, I think you'll come to the conclusion, like I did, that there's something going on that, in my opinion, provides validity and not entire trust, but certainly one to look for reasons to expect the market to perform as we would see in the seasonal tendency. If we don't see the market trading in line with what the seasonal tendencies implying, that actually gives us insight as well. So if at a time when it should be bullish, for instance, with the soybean markets, usually the 1st of February going into the June time period, usually the bullish time period for soybean market. But if the market's actually trading lower, what is that telling you? It means seasonally and influences are not under influence at all. They have no impact at all on price. And there's probably something underlying that's heavily slanted towards a big supply of soybeans. And otherwise, the normal function for higher prices and markup in the price for soybeans isn't being seen. So if we're seeing bearishness during the first half or so of the year, that means there's probably a whole lot of soybeans, that's available, and there's going to be so much supply that demand won't push prices higher. But if there is a condition where we're expecting bullishness, like we see here in the first half of the year generally, if that occurs and we are in a primary bull market or other reasons that would support bullishness are seen in price action, then we could look for the seasonal tendency to support a sustained move going into the middle of the year. Interestingly enough, June time period going into July creates a seasonal tendency to create a high. And then usually it trades down into the September-October time period where it creates another seasonal low. If we look at the top of every one of these seasonal tendencies, you're going to see a small little yellow box here. And the first in the series from left to right, you see MAR, it stands for the March delivery contract for soybeans. The next delivery contract, when March contract expires, you can no longer trade that contract. You have to trade the next month, which would be May. When May expires, you have to trade July. When July expires, you have to trade August. When August expires, you have to trade September. When September expires, you can trade November. When November expires, the next month would be January. Obviously, you want to always try to trade the first or nearby month because that's where all the open interest is generally. There's a few commodities that don't always operate like that, like gold usually has a tendency to skip a month in the latter portions of the year. But the easiest way to do is go into the barchart.com and you pull up the contracts that you would be doing your analysis on. Just look at open interest and volume, whatever has the highest one. That's usually the contract you're going to be looking at or looking to trade. On the seasonal tendencies, there's two lines. There's a solid black line, which delineates 40 years of price data. So that way we can look at the seasonal tendency pattern for the last 40 years. And Steve Moore, who creates this wonderful resource, also plotted a 15-year seasonal tendency pattern. And the reason for doing that is when we have a short-term view of a tendency or data, and you compare it with a longer-term sample size, like 40 years contrasted with 15 years of the same information, if there is a strong seasonal tendency there, that means we should be able to see it both in the short-term 15-year data and the 40-year. And you can see by contrast the heavy solid black line and the dashed red line pretty much move lockstep the same direction. So when we look at the seasonal tendencies, we're looking for that criteria where both of them agree to create a high or a low and sustain moves. So in this case, for soybeans, we can see the 1st of February, there's a seasonal tendency for soybeans to rally going up into the mid portion of the year, June or July. And then June, July, we create a high and it trades down into September, October, creating another seasonal low. On the right-hand side of every one of the slides I'm going to provide you in this teaching, I am not doing any markups at all because I do not want to give the impression or imply that these seasonal tendencies are absolute. I'm not trying to overprove them. I'm only suggesting that you look at the data and you tell for yourself whether there's any validity to it. Okay, and don't just use the last 5 years data like I'm showing you here. Go back as far as you possibly can and see if these things do in fact materialize. And I think you're going to be rather surprised when you see how consistent many of them are. So we know that there is a seasonal tendency for price for soybeans to rally around the beginning of the year. So we can look for the January delineation at the bottom of the weekly chart on the right-hand side, and we should see price rally up into July. And if you look at January 2013, follow that up with your eye, you'll see there's a low and it trades all the way up into July of that year. Very phenomenal, very, very consistent with the seasonal tendency. Then in July, we expect price to trade down into a fall, September, October time period. And it creates a seasonal low in October and consolidates a little bit and then rallies again in January of 2014 into the June month, creating a high for 2014, trading all the way down into what? Yep, you guessed it, the September, October low for 2014. The 2016 time period, you can see that the seasonal influence for price to rally for soybeans comes in effect again, making the high in the month of June of 2016, then trading lower, making the low in October. So I'm going to counsel you to weigh it out for yourself whether or not there's a seasonal tendency here. So if we are a commodity trader in the making and we want to paper trade and see if there's any validity to these things, we know that there are strong tendencies to trade soybeans 3 ways. Look for longs from February going into June, July. Look for shorts from June, July down into September, October. Look for longs September, October going into the following rotation in the summer months. Now that may break up into 2 stages or 2 legs in price action. but that's how you use the seasonal tendency, or at least how I interpret it and how it's served me well over the last 20 years. The next seasonal tendency is Chicago Board of Trade wheat. Now this one's a little funky, but when it's there, it's solid. There is a seasonal tendency for wheat to decline the first half of the year and then make a low second half of June and in August. So we have a little bit of a time period between 4 to 6 weeks where the low could form. And if we look at the July time period on the weekly chart, you can see that there's generally a rally, like in 2012. We can see the rally in wheat. And in the 2013 year, we saw price decline a little bit. That year didn't have the seasonal influence for bullishness there. Same thing with 2014. And in 2015, we saw the market rally going into the July time period. And in the 2016 time period, the bullishness was also not seen as well. And this year, we haven't got to July yet. We can see clearly that the wheat market has been in a strong bearish market. And now, by using that seasonal tendency, let's look and see if there's any influences for sell-offs from the beginning of the year in January going down into June. So we can find the first January in our weekly chart is in January 2013. Follow that line straight up, and you can see there was a high formed around the $8 a bushel, and price traded lower. As a result, down into, yes, the July time period. And in 2014, we actually seen the price only decline for about a month in January 2014. Then it rallied. Then the following year, in January 2015, we seen price decline a little bit and traded down into what looks like May. And then May created a low and started to rally. And in 2016, we saw the market decline. And while it did have a retracement above the $5 mark, it did trade down into a low of the July-August time period. And in January 2017, we did not see a decline. We actually saw a rally. So there's times when the seasonal tendency will not be of any significance at all, won't have any impact on price. But if we ever see the wheat market go into a bull market, the best times to be a buyer that I've seen in historical price action, and you can see it for yourself, is to look for a low in the July, August time period, and then in November. So November and July, August, they're the best times to be a buyer of wheat. When markets are in bear markets, like we've seen in the wheat market here, if wheat is in a bearish market, best times to look for sells is the beginning of the year going down into the summer months. Chicago Board of Trade corn. Okay, so the best time to be looking for shorts, obviously you can see it jump off of the seasonal tendency chart here, is in May. May and June create seasonal tendencies for corn historically over the last 40 years, and it usually drops down into September, October time period of the year where it makes a seasonal low. So we can check this by looking at the April time on our weekly chart and find an April and see if it declines down into September, October. So the first one we can see in 2013, it creates a little bit of a retracement, but falls out of bed in July down into the October time period. Then in April of 2014, it creates the very high of that particular year, trades down into October, September, October, creates the low. Then in the following 2015 year, we can see that April has a decline. It does rally a little bit early in 2015, creates a high and sells off again, but can't get below the 350. And actually 350 stays a support level for a number of months going into 2016. So we don't see any decline in April. We actually see it rally. And that's actually strong because what we're seeing is the seasonal tendency for corn to actually be declining in the spring. It's finding support off of a historical $3.50 a bushel price mark, and it rallies up and challenges an old high seen in July of 2015. Then price creates a low in the September time period when we expect a low, and that's been seen in 2016, and corn has been steadily moving sideways to slightly higher since that price point. And we didn't see any decline. Notice that in April, May of this year, we've actually seen corn go higher. So that I think we have a little bit of a sleeper market, meaning that we might see some bullishness for the corn market because it's not abiding by its seasonal tendency. So if it's not doing that, what is it telling us? Underlying relative strength. Okay, the next one is feeder cattle. If you eat hamburgers, this is where it comes from. If you're wondering what a feeder cattle is. All right, so if we look at the seasonal tendency for this commodity, it usually makes a seasonal low in the April-May time period. It can occur as early as February. If you look at the dashed red line, in the last 15 years, there's been an impulse to create a seasonal low as early as February, but generally, the best moves, as you can see in the dashed line, it really starts to move higher at the end of April going into May, and it creates some seasonal high in around August and September. Then it goes in consolidation. So how do we use this information? It's ideally a good time to be a buyer in the spring and sell it going into the fall. So we can find April and look for basically October. So between April and October, there should be a rally. So if we look at the April delineation for 2013, we can see the market rallied, in fact, from that spring time period all the way up into the October high of 2013, nails the short-term high, then it consolidates, just like the seasonal tendency does. Then in 2014, we see the rally going all the way up into the very high of the feeder cattle market in October 2014. Then in April 2015, we see price rallying again, but it falls out of bed a little early. So in August of that month, or that year, we can see that it had already started to decline, but we still saw an impulse of price to move higher in the feeder cattle market after a long-term breakdown in market structure. And in 2016, we see price actually not see the seasonal tendency have any impact whatsoever because of the overall bearishness on feeder cattle. Then in this year, 2017, we can see that April created a nice little short-term low at the $1.30, and then it rallied, and we've since rallied up to 160, which is a phenomenal price move for feeder cattle. And we still may even go higher, but looking at what's already happened this year, it's been a nice rally from the 130 level up to 160. Every 100 basis points or one full point or handle is $500 per contract for feeder cattle. Okay, the next one is live cattle. This is what you get before you get a hamburger. These are the living, breathing cows. So the seasonal tendency for this commodity is a high forming in the February-March time period and a seasonal low forming in June. So ideally, the stronger impulse is to see a low form in June. So there's usually a markup period seen in the middle of the year going into the end of the year. So it's real easy to use that information by looking for July, essentially on the weekly chart. Find July and see if that creates a low up into the January time period, so that way we can see the weekly chart. So find a July in 2012 and look at the January 2013. You can see it did in fact rally that between these two price points. Then in 2013, we can see that it did rally as well in June of that year, all the way up into the end of 2013 going into 2014. Then again in 2014, June, it creates the low of the year, and then it rallies incredibly, going up and creating the high of the year in what looks like November. And then in the following year, we had the market in a bear market, and influenced by seasonal tendency didn't have any impact at all during the June-July time period. But the sell-off in February-March, starting in 2015, you can see that they actually called really nice shorts and tops in the marketplace. And as the market was bearish, the January, February, March time period each year was creating the really nice sell-offs as the market was bearish. And then we created a nice low in 2016 in the October time period, which doesn't fit anything seasonally, but we started to trade higher. And now this year we saw the market have a little bit of a decline in the February, March going into April, but then April, May, and June, we're seeing the effects of that seasonal tendency here with higher prices